Welcome to Delta Code. I am Delta, an economist with 20 years of investment experience, and I'm here to be a guide through a labyrinth of ledgers, cryptic economic forecasts, and earnings reports that are volatile and move the market. Today, I am going to share with you an investment I made betting on my Coinbase forecast using something called call options to make $8,000 out of $600. I will go slowly and describe to you the jargon in finance about derivatives, call options, contracts. If you already know this stuff and you just want to see the meat of my investment, you can skip ahead. There's timestamps. But if you're interested in learning how call options work and how you can use insights you may have or insights you get from this channel to make a profitable investment, well, stay tuned and don't forget to like and subscribe as we're just getting started, and I appreciate every one of you subscribers to this channel. Hopefully following me will make you wealthier and wiser as an investor, and let's grow together. Let's just jump in. In today's video, I will show you how I used this forecast of Coinbase, Q4 forecast that I made, betting that the market was wrong about how much money they made, using my expertise in crypto and forecasting, which I've done since Coinbase has gone public. The instruments I used the week of the earnings to bet that the market was wrong, where I used about $600 to make it. The instrument I use, it's called a call option. I will slowly show you how to do this, explain the terminology, and teach you about options and derivatives. These may be new words to you, as finance is full of jargon, but don't let that deter you. Once you learn these new words, they should become much more approachable. And just like you might have known what a stock is or what a share is, once you learn what it is, you become empowered to invest into your financial independence. Something I strongly believe is that experience becomes knowledge once you learn from that mistake. And investing is filled with mistakes, and I call these mistakes tuition. When I invest and it doesn't go my way, if I lose money, I call it price of tuition, and I learned. Knowledge becomes wisdom once you apply that knowledge and make a profit in investing. So hopefully I can spare you the mistakes in learning, where you can learn from my mistakes and my experience, and you can just skip to knowledge and wisdom. This is how I made about 1,200% in 1 week during the Coinbase earnings report in the middle of this month. So let's start off with what is a call option, how they work. Then I will jump into the forecast I made and how much it was out of consensus. It was different from what the market expected, and why I made this bet to use options to benefit from a very large and volatile move once the market realizes they were wrong. A call option is a financial derivative that gives its owner the right to buy a specific security at a set price within a certain time period. The word derivative might not be familiar to you. It is a calculus term, but in this context, it means the value is derived. It comes from the underlying asset, which in this case is Coinbase stock. So the call option is a derivative of the Coinbase stock. It means its value comes from the underlying stock, the asset. In the future, if you see dydx, this is also mathematical terminology for derivative. How can you use options in investing? Well, there's 4 primary use cases for it. One is to generate income, to do speculation, as I did in this case, tax management, and risk management. One of you asked me, how do you manage risk when you have such a large position in Coinbase like I do, where it's vast majority of my portfolio, it's over 80%. Well, one of the ways you can do this is use something, put options, where in this case, what I'll be showing is call options. Put options are its twin brother on the opposite spectrum, where you can protect yourself from the downside risk. In this case, we were betting on upside potential, so that's why we did the call option. So what is a call option? A call option is a financial contract that gives the buyer the right but not the obligation to buy a stock at a specific price within a specific period. The call seller must sell the asset if the buyer exercises the call. So if I buy a contract that says I have the right to purchase Coinbase shares at $180 from now until the contract expires, whatever that date is, at any moment I can say buy the 100 shares at 180. And the person who sold me the contract has to have those shares and sell it to me at that price. Why would that person want to sell me such a contract? Well, because the price of Coinbase at the time they sold me was lower and they're happy to sell at 180, plus get something called a premium on the contract. We'll jump into that soon. Let's understand how call options work. They are essentially a contract between two investors. One believes the price will go down and the other one thinks it will go up. The assets can be stocks, bonds, or other things. Option terms, the contract is an option. It's a choice to buy the asset at a specific price by a certain date. The date is called the expiration date, also known as expiry, and the asset is called the underlying asset, also known as the underlying. Now stay with me. These are just few terms, and then we'll get into how this actually works. The price is called the strike price. Think of it as in bowling, you get a strike. The price is called a strike price, and the strike price and the exercise date are set by the seller and chosen by the buyer. There are usually many contracts, expiration dates, and strike prices traders can choose from. So a seller can put a contract up for sale and nobody has to buy it. There can be various amounts of strike prices and expiry dates, and then the buyer will browse through them, as I will show you, and you choose the one that best fits what you're trying to accomplish in the time frame you're trying to do. As the purchaser, you pay a fee to purchase this call option. This is called a premium. It is the price you pay for the option to exercise the contract. If at expiration, the underlying asset is below the strike price, the call buyer loses the premium paid. This is the maximum loss the buyer can incur. So if I bet that the Coinbase stock price will be 180 before the time of expiry, and anytime it's over that, plus my premium, I am in profit. But if it is, let's say, 175 below 180, there is no reason for me to exercise this contract and pay 180 for something I can buy on the open market for 175. So the options contract is only valuable if the strike price is below the current market price or close to it, and there is time left on the contract, which is called time premium, that has value. So to recap, a call is an option contract giving the owner the right but not the obligation to buy the underlying security at a specific price and a specific date. The specific price is called the strike price, and the specific time which the sale can be made is called the expiration or expiry, or time to maturity. You pay a fee to purchase this call option called the premium. This is per share charge and is the maximum you can lose. The call option may be purchased for speculation or sold for income or purpose tax management or risk management. Call options may also be combined for use in a spread of combinations and strategies. So the contract ends up being the buyer's choice. The call option, the buyer may hold the contract until the expiration date, at which point they can execute the contract and take delivery of the underlying. If you buy a call option for, let's say, oil, at the time when the contract expires, you can be entitled to take delivery of whatever barrels of oil. In this case, each contract is worth 100 shares of the company, at which point you can say, I'm exercising my contract. Here's the money that we agreed on per share price, and I'm paying you, and you have to sell it to me. I'm hoping that the price is higher at that point. The buyer also can choose not to buy the underlying at the expiry. They can sell the option contract at the point of expiration at the market price at the contract time. So I don't actually have to purchase the shares that the contract gives me right to. I can sell that contract to somebody else because it has a value, especially if it's in the money. In the money means that the contracted price is below the market price. So per share, it is net positive. Also, vast majority of options expire worthless. I think about 75% if my memory serves me correct. That's why up here I put a big zero. Zilch is what you can expect 75% of the time when you purchase an option to happen. You will lose your money. When looking at the contracts, option contracts, there are Greek letters, also known as the Greeks, fittingly, that are describe the risk parameters of this contract. They tell you about the volatility and how much the price of the contract will change based on time and the changes in the price of the stock itself. So, delta, gamma, vega, and theta, and also IV. IV is implied volatility. That's not here because it's not a Greek. But most importantly, first of all, delta. Delta is the measure of change in the options price or premium resulting from the underlying change of the asset, while the theta measures the price decay as it relates to time. So, delta is for every dollar change in price of the stock, how much will the options value change? Gamma is the measure of how much delta changes over time. Vega measures the risk that's changes in implied volatility, and theta measures decay of time premium. This is an important one, theta, especially when you don't have much time left before the contract expires. Closer it gets to expiration and the value of the contract is below the strike price, it becomes very severe and exponential. At first, the decay is slow, but closer you get to it becoming worthless, each day it loses value. Could be each hour, honestly. When dealing with options, volatility is actually your friend. You want to purchase an options contract during a time of low volatility because that will reduce the implied volatility in the price of the contract, making it seem unlikely to happen. Industries that have high volatility are technology, biotech, energy, cryptocurrency, and financial services. These industries can be very volatile. Why? Well, technology often is a impactful industry where if we followed NVIDIA's earnings, they saw 250% revenue growth year over year. Similar with Coinbase in this scenario. Biotech companies or pharmaceuticals, they may have come up with a new therapeutic, a new treatment for a disease, which day to day changes substantially the value of the company. If yesterday we did not know that this company cured cancer, and today we know, well, the value of how much the cure for cancer is worth drastically impacts the value of the company. And drug companies are constantly involved in this development phase of new and treatments for diseases. And once FDA approves a drug, usually the value of the company that developed this drug will skyrocket the same moment the FDA announces that it was approved. Or vice versa, the value of the company will go down as people might have bet on the approval. And since the vast majority of drugs do not get approved, usually the stock goes down. So a lot of investors actually bet on this, it's called dark side of investing, which is this will not get approved, the price will go down. So by purchasing options, you limit your downside, but you have a huge upside. In this case, what I was betting on was an intersection of technology, cryptocurrency, and financial services, which is Coinbase. So 3 out of the 5 most volatile industries rolled up into one company. So volatility is expected when investing in Coinbase stock. This is a concept that every good investor or poker player should learn. It's called positive expected value. It is a fundamental concept in investing that helps investors make an informed decision by assessing the average profitability or probability of an investment over time, considering the range of possibilities and outcomes and their probabilities. So if you remember, I said that 75% of all options expire worthless, which means the investors who bought them lost 100% of their investment. If you're only going to win 25% of the time, that means the upside has to make up for the downside. So why did I make this bet? Knowing that 75% of options become worthless, and this was a vastly out of money call option. Well, this is why. Earlier this month, I published an article on my Substack with my forecast for Q4 of Coinbase, as well as my YouTube video. I hope you've seen it. If not, check it out. It's worth a watch. In this video, I forecasted that the Q4 results for Coinbase were going to be very different than Q3, given how much crypto prices have changed from quarter to quarter and how much transaction revenue Coinbase would have. During my in-depth analysis, I forecasted that it's going to be 35% greater revenue than in Q3, and other analysts predicted that it will be about the same. Now, to be fair to those who thought it would be the same, kind of Coinbase said that it would be. But Coinbase doesn't know. They did not know at the end of Q3 what Q4 would look like. They were just guessing at the time. But when I made my forecast, it was less of a guess. I had more information at the time than Coinbase did when they gave their guidance. So, acting with superior information flow, I can make a forecast that's better than the guidance. So my forecast was this. My forecast was 917 million of revenue instead of 600 and whatever 40, which was a 35% quarter-over-quarter increase, or a 243 million bump. What actually happened? Coinbase delivered a $954 million revenue, which was actually even better than mine. It was 41% better than Q3. So I was off by 4%. By other analysts were off by 40%. So I was slightly off. Everybody else was extremely wrong. So being confident in my forecast, knowing my forecast and having confidence in it, when this happened on February 5th, I thought the price was going to recover, heading towards the earnings, as people will realize they were off. But start of February, the price started going down, and on the 5th, it dropped from 130 to down to 117. At which point I said, no, you don't, and I purchased a call option. Here is an export of my brokerage account of what happened. On the 5th, I saw that chart, and if you followed my forecast, what I believed would happen was it was going to go back to 180. So I sold a few shares of Coinbase, Billy, and Snap that I had in my portfolio to get about $600. With that money, I bought 10 contracts of 55 cents of a March 1st call option at a strike price of 180. So the price would have to be at 180 and 55 cents for this contract to be profitable. The next day, I noticed the price dropped a little more. It dropped down to like 30 cents. So I bought one more Retrospect, wish I bought more. 2 days later, the contract price was $1.22, at which point I sold 4 of my call options, getting back about $500, basically recouping my original investment. Now, rest of these contracts, these other 7, were basically house money for me. So I was willing to let them ride until March 1st, which is still a week away. The next day, the price went up to about 5 as Coinbase started going up. As we can see, price started going up before the earnings, and I set automatically limit sell prices at 5, 7, 8, 10, and so on. Eventually, each day, some got sold, especially on the day after the earnings report. Earnings was on the 14th. I sold 3 contracts at about $8, one at 7, 2 at 8. The next day, I sold 1 at 10. And then the next day, I sold some at 18 and 20. 20 is the highest price this option contract went to. Do I wish I sold all of them at 20? They would be worth then $22,000? Yes. But I had no idea about how much this would move. Obviously, I thought it had potential to go to 20. That's why I put a limit price for sell. But I was happy to take my money back at 120 once it doubled and let the rest ride for various amounts of profit. If they only went up to 8, then I would have, profited just these few $1,000s, but it kept going up, so I made more profit. So this is in about 10 days time from the 5th to the 16th that this trade was open. I could still hold these options, but I sold all of them. And in retrospect, it was a good move given that the price of Coinbase has corrected from 190 back to 165. Again, this is the gap right here. If you followed my previous videos, you'll know that gaps usually become the trading range afterwards. So I expect between 160 and 180 trading before it shoots past 200. In my previous video, I've shown this chart about Coinbase income journey, how in 2020 they started becoming really profitable, making billions of dollars per quarter. And then they overhired, and then the crypto winter hit, and they had too many employees and not enough revenue, and they were overinvested in R&D, spending too much on marketing. And you can see in red here, they were losing lots of money, which was not warranted given their actual revenue. 2023 was the year of getting their accounts in order. They downsized a little bit of their workforce, get it to a manageable number where their revenue justified. And I forecasted they would turn profitable in Q4 and going forward the rest of the year, probably well into 2025. Still, these are small numbers, and I expect them to start printing money like this going forward. If you watched my latest update on Coinbase, you'll know that my Q1 of 2024 forecast, I expect them to make close to $1.2 billion. This is going to be a 25% increase from the previous quarter. Hopefully, the analysts, again, are betting on a lower number and will be wrong, and we'll have another opportunity to make a trade on call options. Now, I usually do not trade. I'm an investor. I buy for long term, and I hardly ever sell unless the investment loses money or I find a better opportunity as an opportunity cost. Rarely I see a trade opportunity like the one with the options here, or sometimes a short opportunity, sometimes a short squeeze, as I shown with my 3 top short squeeze opportunity companies, Carvana, Redfin, and Upstart. Carvana reported today, and it's to the moon. So if you followed me there, also probably you're welcome. Do check out this Coinbase Q4 video. and the Q1 forecast. I will update my forecast for Q1 in April once more of the quarter has gone by and I have more data to make a very accurate forecast. At which point, again, we will be dealing with better information than Coinbase guidance. And if analysts and other investors are going solely off of the guidance that is lagging by a month and a half, we have an advantage. Keep in mind, Coinbase makes a lot of their revenue on trading volumes, and these are the trading volumes as of now. They're about 100 billion. This is nowhere near the peak of 300 billion of the previous cycle where Coinbase was making a lot of money. Once these numbers start heading towards 300 billion or past, we can expect Coinbase to make money like they did in 2021. Like this. We can expect $1 or $2 billion of profit in the following quarters, maybe not this year, but maybe towards the end of the year as crypto prices go up. We have Bitcoin ETF that is the most successful ETF in history that's seeing hundreds of millions of dollars of inflows. We may have an Ethereum ETF in May of this year. Crypto prices have almost recovered. The top of the market cap during the 2021 bull market was 3 trillion. Right now we're about 2 trillion, with slightly above, with Bitcoin being worth 1 trillion by itself and Ethereum about 300 billion. If crypto keeps going up in price, in market cap, and trading volumes on Coinbase keep going up, if institutions keep getting interested in the market in this space as they have been, then we can expect Coinbase to return to 2021-like numbers and even better. I don't think Wall Street is at all considering numbers better than this. If they were, Coinbase would not have the current market cap. Coinbase is currently worth only $40 billion. This is a ridiculously small market cap for a company of this quality that produces this much cash flow, that has this much revenue and this much potential growth, as well as being the leader of its industry. If this was any other industry other than crypto, this company would be worth $200 billion, in my opinion. Now, it is fair to say that this market cap is muted because of regulatory risks that may impact Coinbase negatively, and that is a fair assessment. At any moment, the government can do something stupid that will impact Coinbase's business negatively, and they have done this in the past. But so far, court cases have been in favor of crypto companies and crypto industry, as SEC has been found capricious and arbitrary in its enforcement actions that they do not have rights to enforce. They are seizing power that the Congress never gave them and trying to enforce them on the industry they have no right enforcing. Right now, several leading industry figures and companies are preemptively suing the SEC to get clarity before they do things that may be found by SEC as breaking the rules they make up on the spot. So when I'm deciding to buy an option, I do something called options modeling, profit and loss, and I put it on a spreadsheet that looks like something like this. This is a spreadsheet I made for Coinbase option that expires March 21, 2025. At the time, it was over 200 days until expiration. Actually, it was 749 days until expiration. Coinbase price was $65. So it was $100 cheaper than it is now. One of the things I included was Bitcoin halving and how that is correlated with the impact of correlated with prices. And then here, I bought 6 contracts. I paid an average price of $2,000 for them. Here is the model of how much I expect it to be in profit at each price. Right now, it's $43,000 in profit. I think it's closer to 50. At 180, it's about $50,000. And so on. So if it goes to 400, this $12,000 investment will be worth $180,000. It is hard to get these kinds of returns in any other asset class. This is why I do options. So right now I invested 12 and it's worth about 50. That's a really decent return. In my sheet, I also keep the Greeks, delta, gamma, theta, vega, and IV. And I write what they each are, their definitions, as I look at the price of the options contract. What did we learn about options today? They are a contract that gives you the right, but not the obligation, to purchase the underlying stock at a specific price up to a certain specified date. Most options expire worthless on their expiry date, and they're extremely risky. Only time you should invest in options or trade them is during times of volatility and if you have certain insights. I'm a little conflicted with showing my subscribers how to do options. Options are inherently very risky, and I don't want you guys to lose money. If you're going to invest or trade with options, please take time to learn how they work. Do it in a virtual setting first. Do it with fake money first. And you can do this. If you go on Yahoo Finance, make a portfolio, you can put in a option and pretend like you bought it. You can go into your Robinhood app and just put a option on a watch list and pretend like you bought it and see what happens. Do this at least 5 or 10 times before even investing $100. And when you actually do it, please only do it with very small amount of money that will not hurt you if it goes to zero, because as I mentioned, 75% of options expire and they become worth zero. In certain scenarios, if you bet in the right direction, you can make hundreds of percents, thousands of percent return. This is rare. You need to have special insights and be right. And you can be right and the market still does the wrong thing. It's many ways to lose money. So please be careful. Again, I'm very hesitant about even bringing this up, but options are and can be very profitable and a great way to make money. It is also my opinion that when you're getting started, it's important to double your money as many times as you can. When you have a lot of money, you don't want to risk it and try to double it. Then you want to try to preserve it and invest in safe assets that have low risk, because you don't need to make your 10 million or 100 million into 200 million. You're happy just having your 100 million and earning 5% interest with 0% chance of losing it. It's more important to not lose your money than to double your money. But when you're getting started, I think a certain percentage of your portfolio should be allocated to high-risk investments that have a potential to double, triple, 10x. These investments, if and when they work out, can pay for all the ones that don't. This is the positive expected value. Some of the most profitable investments I've made have been options, long-dated ones, and risky investments like crypto that have yielded me thousands of percent of returns and are the pillar on which most of my wealth is built. Now, these took a long time for me to learn how to invest in. I've lost hundreds of dollars in the learning process, getting a lot of these wrong, betting on things that seemed like a sure thing that didn't work out. Even if you look at my first article I wrote on Seeking Alpha about Coinbase, where I forecasted the revenue and I was right, but their guidance was lower for the next quarter. So even though I was vastly out of consensus, but still correct on how much money they made that quarter, and the other analysts were wrong, what I did not foresee happening was Coinbase saying next quarter will make less money. And that had a much bigger impact on the stock price than my forecast being correct of the previous quarter, how much money they made. So even you can be right and the markets can still go against you. I can be right about Coinbase forecast for the next quarter, and maybe a week before, the government can come up with some news, some sort of a lawsuit that negatively impacts the price. And if you invest in something like an option where a little bit of volatility can have a huge impact, it can cost you. So please be careful. And nothing is a sure thing in investing. Watch your positions, position sizing, and never invest more than you can lose, especially in options. A couple of weeks ago, when I bought these options I was perfectly willing for that to go to zero. $500 is such a small amount of money in my investment portfolio that I would be upset that my forecast was wrong, because that's the only reason that probably wouldn't have worked out. But if it went to zero, that was a $500. It wouldn't be the end of the world for me. But that $500 became $8,000, which is a more significant amount. Well, that is options, call options simplified with a little practice and a little investment of time in learning. You can have another available tool for you to invest in. Please be careful. Options are inherently very volatile and very risky. If you have lots of shares of some stock, you can sell options that are far out of money and produce income for yourself or downside protection. This is probably the smartest way to use options once you have acquired some wealth. As you're getting started, it is one way to leverage what little money you have trying to make large returns. Again, this is very dangerous. Please use it with caution and only if you have some amazing insights and spot a huge mispricing in the market. Until next time, thank you for tuning in. Don't forget to like and subscribe. And as always, may the power of compound interest be with you. Peace.